Welcome to the SmartKeys podcast, your weekly deep dive into the technologies and strategies that are really redefining the future of business.
Today, we're jumping into a critical analysis of the vertical SaaS landscape.
Yeah, and this isn't just about software features. We're talking strategic insights, roadmaps for growth, and maybe most importantly, what investors are actually looking for as we head into 2026.
That's right. Our mission today is pretty targeted. We want to cut through all that general enterprise noise and really pinpoint the niches with the highest momentum.
So if you're a founder or maybe a product leader or an investor, this is for you.
Exactly. We want to arm you with the data, the efficiency ratios, the retention figures that, really prove that specialization, that vertical depth is the winning strategy right now.
And the numbers, the market divergence is pretty stunning. Enterprise software is doing well, grew about 11.1% in 2023.
Which is healthy, no question.
But when you isolate the specialized vertical SaaS segment, the forecast is for expansion between 12.3% and, get this, 15.2% through 2034.
And that just crushes the roughly 9.6% projected for the broad horizontal market.
It does. Okay, so let's unpack this. The shift from, horizontal breadth to vertical depth isn't just a theory anymore.
No, it's a measurable financial reality. And it all starts with solving a massive shared frustration in the business world.
Which brings us to the core problem, the dreaded toggle tax.
It's so real.
Our sources paint this picture. The average small to mid-sized business is juggling around 16 different applications.
16. Just think about that for a second. It's constant context switching, moving data from one silo to another.
It's a total productivity killer, and it's a financial drag that's almost completely invisible on the balance sheet.
And that is exactly where vertical SaaS comes in. It's all about built-in precision.
It's not just software for an industry, right? It's software that actually speaks the language of that industry.
Yes. It embeds the specific compliance rules, the exact workflows.
Right.
So if you're a contractor, the software uses construction terms, not generic business jargon.
Which means your adoption risk is way lower. You're not spending 6 months and a ton of money customizing a generic system.
You're not. You buy something that just works pretty much from day one. It shortens that time to value and, crucially, lowers the change management you have to do.
And that speed, that precision, it translates directly into better unit economics.
This is the headline. Let's look at the numbers.
Okay, so sales and marketing costs. S&M, specialized vendors, are running at about 17% of revenue.
17%. Now compare that to their broad horizontal competitors.
They're at 34%, double. So how do we explain that massive difference?
It's like hunting with a rifle versus a shotgun. The horizontal guys have to cast a really wide net. Huge sales teams trying to convince everyone their generic tool is the right fit.
Whereas vertical SaaS sells to a very specific, concentrated group.
A group that all shares the exact same operational pain. The solution is so tailor-made that the product almost sells itself through word of mouth in that tight-knit industry.
So you've got lower customer acquisition costs, faster payback on that spend, and just, higher returns overall. It's just a more capital-efficient way to grow.
And what's fascinating here is that it confirms what buyers want. They are prioritizing efficiency. They are prioritizing lower churn. They're tired of having to adapt their business to the software.
They want the tool to fit their workflow, period.
Exactly. And that's driving much better retention for these vertical players.
And then you take those strong fundamentals and you turbocharge them with two massive compounding forces, AI and embedded fintech.
These aren't just features. They're driving revenue and retention lifts of 2x to 5x for some companies.
This is where it gets really interesting. These integrations turn a useful tool into something indispensable.
Absolutely. Let's start with embedded fintech. Historically, things like payments or lending happened outside your main software.
Right, in a separate system.
Now, by pulling those finance operations right into the platform where the work is already happening, these companies convert simple product usage into transaction revenue.
So when I process an order in the software, it also handles the payment.
Precisely. And that transaction revenue often comes with much higher gross margins than the subscription fee. It turns your product into a financial utility.
And it makes it incredibly sticky. You can't just switch providers easily if your entire cash flow is running through the platform.
It's a huge moat. And then you have the other lever, AI. Large language models have completely changed the game here.
We're seeing systems move from being passive systems of record to active systems of intelligence.
And that's such a crucial distinction. Let's break that down. A traditional system of record, say in manufacturing, it just stores the fact that a component failed.
The what, the when, the where.
Right. A system of intelligence takes that record, analyzes it against all the other contextual data maintenance logs, environmental conditions, and then it predicts when the next part is likely to fail.
Before it happens. So the value shifts from storage to prediction and prescription.
That's the key. And this is where Vertical SaaS AI really shines. They have the proprietary domain-specific data, the jargon in legal contracts, the molecular structures in a lab.
Data that a general AI wouldn't understand the context of.
Exactly. That fuels machine learning that can provide genuinely useful automated decisions and predictive analytics. The key, though, is that it has to be explainable and safe. Because if the users don't trust the AI's decision, they just won't use it.
Which brings us to the blueprint for how the best companies are doing this. It's this land, expand, and embed strategy.
Yes, the winners are incredibly disciplined. They always start with a really narrow wedge.
They find one specific, sharp pain point in an industry where the old tools are just failing over and over.
And they solve that one thing brilliantly. They win that beachhead, and only then do they start expanding into other solutions.
Let's use Toast as the perfect example in the restaurant space. Their wedge was the point-of-sale system.
A notoriously manual, error-prone workflow. They didn't just digitize the cash register. They made the POS the operations engine for the entire restaurant.
The initial land was smart, but the embed phase was genius.
It really was. By integrating payments directly, fintech now drives something like 82% of their revenue. The software subscription is only 18%.
They became indispensable by owning the money flow, and the results speak for themselves. Their net revenue retention, or NRR, hit 121% from 2020 to 2023.
That is just incredible, durable growth. It means they're not just keeping customers, they're growing with them as payment volume increases.
And then there's another great case study, Benchling, which took a different route.
Right, in life sciences, their wedge wasn't payments, it was data.
They started with a freemium electronic lab notebook, an ELN. It was a high-frequency workflow that got a ton of scientists onto the platform.
And that was the key. That freemium model let them capture this incredibly rich, proprietary domain data about experiments and molecular processes.
Once they had that data foundation, they started to expand and upsell into enterprise solutions.
Molecular biology tools, early development modules, they built out a full operating system for R&D. And the result? They blew past $100 million in ARR with a staggering 169% net retention.
So the playbook is clear. You position yourself as the system of record first, capture that unique, valuable data.
Then you leverage that data to build out other high-margin services, especially payments and AI, that drive that stickiness and growth.
So this leads us to the future. Let's look ahead to 2026. If you're building or buying or investing, where do you look?
You have to find where operational pain and measurable ROI intersect. That's where the capital's going to flow. We've identified 5 key sectors.
Okay, number 1, construction. A sector that's notoriously slow to adopt tech.
But the pain is acute. You have data from the field that never syncs with the office in real time. Yet 97% of firms are planning bigger digital budgets. The opportunity is massive.
So the focus is on field ops, job site coordination.
Exactly. Tools that bridge that field-to-office gap and deliver real ROI, like faster project schedules.
Number 2, manufacturing. The challenge here is data trapped in legacy systems and manual defect detection.
The opportunity is in MLOs and defect intelligence on the factory floor. Things that can prove they lift throughput or cut material waste, it has to hit the bottom line.
Third, healthcare. A tough nut to crack, but the potential for automation is huge.
The key is building solutions that map directly to existing EHR workflows. Think AI triage or predicting staffing bottlenecks. Things that reduce wait times and improve capacity utilization.
Okay, fourth is agriculture. A surprisingly advanced sector, actually.
It is. 85% of farmers use at least one precision technique. The next wave is full autonomy and high-precision input management.
So tools that can prove they lift crop yields or cut costs on things like fertilizer and water.
Precisely. And fifth, real estate and hospitality. Both are incredibly fragmented.
AI alone could add up to $180 billion to the real estate sector.
And in hospitality, you have hotels using dozens of disconnected systems. There's a huge opening for a platform that can finally consolidate and orchestrate all of that.
Now, we've painted a pretty optimistic picture here, but we need a quick reality check on the capital markets.
We do. We've officially moved out of the zero IP, zero interest rate policy era.
The market now prizes operational discipline and efficient growth. The days of growth at all costs are over.
Valuations have normalized. Every dollar you spend needs to work much, much harder. Blitzscaling just for market share isn't the winning move anymore.
So if you are fundraising, you have to show an efficient sales engine, rising NRR, and disciplined spending.
Which conveniently are the exact strengths of a good vertical SaaS business.
And this new environment is shaping M&A too.
Absolutely. We're seeing more product tuck-ins, large companies buying smaller ones to fill a specific capability gap fast.
Hmm.
It's not about pure land grabs anymore.
So you win by showing a defensible moat and those efficient unit economics.
Exactly.
Okay, so as we wrap this up, the core playbook for you, our listener, seems really clear. You turn deep domain knowledge into repeatable software.
And you focus relentlessly on a single high-impact pain point. Then you embed AI and fintech where decisions are being made and where money is flowing.
And you have to prove that value fast. If you're not thinking about embedding payments in 2026, you could be leaving a ton of margin on the table.
And one final thought. If you're on the other side, evaluating these vendors, you have to treat it like you're choosing core infrastructure, not just buying a feature.
What do you mean by that?
I mean, the hidden risk here is vendor lock-in. Before you sign anything, you have to demand clear data portability and contractually defined exit paths. Don't let the value of a specialized tool lock you into a brittle process or an unstable vendor.
That is critical, actionable advice. That due diligence is your final competitive advantage.
It absolutely is.
Well, thank you for participating in this deep dive. This was fantastic.
My pleasure. It was a great conversation.
If you found these insights valuable, make sure you subscribe to the SmartKeys podcast wherever you listen. We dive into efficiency and business insights like this every single week. And for a full list of all the metrics and sectors we discussed, you can find the link to the full article, The Vertical SaaS Landscape, Niches That Will Explode in 2026, right there in the show notes. We'll catch you next time.